factored against the lowest interest rates in human history. If we see rates rise, it will be the perfect trifecta. And I think it will be not just a recession, it will lead us into a depression. So my guess is that inflation is here to stay, and there'll be lots more of it. And there may be a little bit of jawboning and acting as though they're going to get tough on inflation over the next several months. But I think as soon as we get near 3%, on the 30-year, it's over. I think that the whole market throws up upon itself, and they go back to what all administrations have done, all the way back to the Roman days. I think what they're going to do is let the interest rates rise. They're going to sell off some of their balance sheets. They're going to have a very hawkish rhetoric, and I think you will see the markets react adversely when that happens, as anyone's guess, March or April, as this all starts to unfold. I mean, heck, you got Powell talking not only that, but about only holding treasuries on their balance sheet. That's $2.7 trillion worth of mortgage-backed securities that would have to be unwound. So you're talking the three pillars of wealth: stocks, bonds, and real estate, all potentially being hammered with the rise in interest rates. So, the question is, do they sacrifice the markets, or do they do what all politicians have done preceding, and that is to sacrifice the dollar? And I think ultimately that is what they will do. When we talk about inflation, I think it's important to note that they've been lying to us for a very, very long time. Aside from the fact, Charlotte, that rates are 7.5%, or excuse me, inflation is 7.5%, excluding so many of the things that are inflated, like food, like energy, like housing. We just saw a report issued by the Levy Economic Institute where the numbers from the 2008 through 2010 financial crisis were released. It was a Freedom of Information request, Freedom of Information Act, that went all the way to the Supreme Court. The Federal Reserve had these numbers sealed for 2 years and then decided to seal them for another 10 when, through a FOIA request, all the way to the Supreme Court, they were finally released. They told us in 2008 that they put $700 billion into TARP, another $700+ billion into infrastructure. And that is what we saw the Tea Party come of. The Tea Party was a reaction to crazy $1.4, $1.5 trillion expenditure. That was considered obscene and ridiculous. They also told us they gave $3 trillion to the banks to bail them out, right? Well, what we just saw from the Freedom of Information Act and the released files is that that number was actually $29 trillion. And it was given to all sorts of commercial banks, including $2.5 trillion to Citibank, basically nationalizing them. And they are co-owners of the New York Fed. There's a problem there. It's very incestuous. But they gave money all around the world, to the United Kingdom, to Japan, to Germany. And we're seeing inflation prints in the UK, the highest since World War II. We're seeing in Germany, the highest in 30 years, the highest in several years in Japan. We are spreading inflation across the globe. And I think that the moral of the story is that to me, and this precedes the COVID spending. This precedes the 2019 repo market spending. We've been talking a lot about when we look at all the dollars ever created in the history of this country, over 50% of them were created in the last 2 years. You put it all together, they have chosen an inflationary path over austerity, over the tough decisions. And I have a really hard time believing that they will blow up the economy by letting rates rise. I think they will raise them just enough to freak everyone out, to give them some wiggle room, and then they will come back in and they will accommodate and they will stimulate and they will keep interest rates, they will change their path and go back to lowering of rates and more injections of money into the system. Because when you have bubbles like we have seen, super bubbles at all-time highs and all-time valuations, factored against the lowest interest rates in human history, if we see rates rise, it will be the perfect trifecta. And I think it will be not just a recession, it will lead us into a depression. So my guess is that inflation is here to stay, and there'll be lots more of it. And there may be a little bit of jawboning and acting as though they're going to get tough on inflation over the next several months. But I think as soon as we get near 3%, on the 30-year, it's over. I think that the whole market throws up upon itself, and they go back to what all administrations have done, all the way back to the Roman days when they clipped the coins, and they will choose inflation and the printing press over the tough decisions. So, yeah, I think it's going to be more of the same. I think we all need to buckle up and get ready for what I think will be an inflationary path when this is all said and done.
Okay, I think you're touching on so many questions that people really want to hear the answers to. So we have an idea now of what you think the Fed is going to do in the next months. How do you think that precious metals prices will react if it goes as you say? Because as you were saying right at the beginning of this interview, prices have not reacted in the way that people have hoped, at least so far.
Yeah, I think that ultimately precious metals will react the way that we all think they will. If we go back to 2017, when we started to see central banks accumulate gold, we've seen the Bundesbank of Germany, the Bank of Turkey, the Bank of Poland, the Dutch National Bank, the Bank of Austria, the Bank of China, of course, the Bank of Russia, who now says they hold more gold than they do dollars in their reserves, the Bank of India, the Bank of Serbia. I mean, all of these banks are copiously accumulating gold. We're seeing massive withdrawals recently off of the London Metals Exchange and the Bank of England. I think in January, the numbers were 26 tons of gold taken off of the London Metals Exchange and the Bank of England, over 600 tons of silver taken off. We've seen repetitive deliveries off of COMEX, backdooring out of ETFs. All of this is being done in a way that sidesteps, in many respects, the reporting, the backdooring for the authorized participants out of SLV and GLD, the withdrawals out of the London Metals Exchange and the Bank of England. These things are not very well publicized. It allows the big banks, the big money centers, the sovereign wealth funds to reposition. They are repositioning and de-dollarizing and using the manipulated paper price on COMEX to run cover. You don't see these kinds of massive deliveries off of the exchange to the biggest money in the world if they don't expect the prices to go much, much higher. And when you talk about silver, I mean, Charlotte, look at what silver offers. It's a depleted asset, right? It's a depleted asset in nature. It's found at the very top of the surface in a form called epithermal, which means the big deposits largely were found decades ago, before the advent of advanced imagery. And so you have an asset that is depleted in nature, but has experienced a monetary renaissance, and at the same time has a whole slew of new green and digital applications that are coming online. That is depleting. It is an asset that has expanding utility and needs in industry, and has globally experienced a massive wave of monetary demand and interest.